Good morning, Eric.
Morning, Ed. How you
How are
doing?
you? Good morning, everybody. Thanks for joining us. It's November 4th. Tomorrow is Election Day. Eric, did you get around to voting yet?
I'm going tomorrow.
Yeah,
Just
me
going to the
too.
polling
So,
station.
well, based on the polls, Eric, it seems to me that we're going to have a contested election. I mean, all the polls seem to be saying it's neck and neck, even in the key swing states. So that it would not be something to look forward to. So hopefully, we're not going to have that. But if we don't have that, then very quickly we'll find out that half the country's very happy and the other half is very depressed. It seems like it's a 50-50 kind of a proposition. And it seems like a lot of people are going to vote for the person that they least dislike, I guess is the way to put it. But anyways, I know that Harris and Trump both have their bases that love them, and the rest of us are just trying to figure out who's going to do the least amount of damage. I'm actually writing a piece for tomorrow, kind of reviewing GDP, and it's a glowing report, but I don't want it to be political, especially on election day. I don't want to have people say, "Oh, yeah, Denny's favoring the administration because he's saying how great the economy is." We've always had this view that the economy's done well despite Washington, and I still have that view. I don't know if you had that view, Eric, but you know, working for me for a while longer, you'll hopefully it'll rub off of you that you'll see that how often the economy just continues to plow along. I think it's because most of us are working stiffs. We're either doing what we're doing or we got businesses we're running. And we don't really have a lot of time for politics, so we do the best we can and do the best we can, factoring in, we're realistic, factoring in that we've got to deal with Washington, and somehow or other we do that and things move forward. I'm impressed by the diversity of the economy. Not only do we have S&P 500 companies that we all pay attention to, and then there's the 400 and the 600, the mid caps. There's also 30 million proprietorships out there, and they account for about $2 trillion in personal income. Proprietary income shows up in personal income. So that's looking pretty good. But Eric, before we turn to what the topic of the day, how's the weather by you?
It's good. 70 degrees, like always.
70? Yeah, we've got it's turned cold here, but we've had I think almost like 40 days straight of clear skies and no rain, so can't really complain. But our topic today is about the bond vigilantes and how they seem to be fed up with the Fed. I was on Bloomberg this morning, and John Farrow pointed out a few times that the bond yield was down 10 basis points, and that was the big deal today. And apparently, Eric, did you hear about the Iowa poll?
Yeah, what was Seltzer or whatever?
Yeah,
Faith Harris. Yeah.
she's a pollster that has some credibility, and she's saying that older women are turning out more so than maybe in the past, and that Iowa could be a surprise, and then Wisconsin's not far away, and that could be a surprise. So that's that. So I guess John was implying that the possibility of Harris winning brought the bond yield down by 10 basis points. I mean, there's a lot of moving parts here, Eric, and who knows, but our take still is that one of the more important driving forces has been the economy and the Fed. That's the old expression that Carville came up with. It's the economy, stupid. And what the economy has done is basically what we anticipated, that the economic indicators would turn out to be better than people thought during the summer. And as a result of that, the bond yield would go up. And we thought the Fed would cut by 25, not 50 basis points. When they went to 50 and we didn't see a lot of justification for it, we became even more bearish on the bonds. thinking that the bond market might conclude that the Fed is overstimulating the economy. It's stimulating an economy that really doesn't need any stimulating. So that's kind of been our position that it's the juxtaposition of a Fed maybe making a mistake here. And it looks like Eric, the Wall Street Journal had Nick's article about the Fed. You read it?
Yeah, I just get the notifications for him.
Yeah. What was your conclusion from what Nick's
Uh, yeah, bottom line, just they're cutting by 25 basis points. I think the bigger question mark is what's Powell's tune in the press conference, right? Does he push back a little bit on some of his dovishness at Jackson Hole in the last meeting, or does he kind of double down on it and say inflation is falling, it's close to 2%, and we're going to keep cutting to get us back to neutral or less tight?
Yeah. Well, of all the Fed watchers in the media, it seems as though Nick is the go-to guy. The Wall Street Journal is where the Fed likes to go to kind of give a heads up to the markets that they might be thinking about changing something. So I think one of the conclusions is they're not signaling that they're not going to do anything. So our view that it's going to be done and done is going to be wrong, at least in November, if that's in fact what they're going to do, and cut
Mm-hmm.
by 25 basis points. So maybe we'll be half right. Maybe they'll do 25 in November, and we'll say none and done for December, and then we'll take a little rest and then start it all over again next year. But the bond market it's has gone the other way. What's the basis points that we have now? Is it 60 or 70 that we're up since the Fed cut the Fed funds rate?
Yeah, I guess we're about up, yeah, 65 or 70 basis points, or about
Right.
4.3%.
Now you were pointing out in the piece this morning that it's not just the 10-year bond yield, but what's going on with the 2-year?
Yeah, you would have thought if this was all about a recession being taken off the table because the Fed is cutting and committed to cutting, the yield curve would have steepened a lot, but it's still pretty flat at around 15 basis points. The 2-year yield has actually jumped up more than 60 basis points since the Fed
Yeah.
cut. So it's really the entire yield curve shifting higher since then.
So I think in terms of what's bothering the bond market, it's that the economic indicators have turned out to be better than expected. It's interesting though, the bond market has been correlated with the oil price, and the oil price is down, so that suggests the bond yield should be down. The uh, ISM MPMI, the Purchasing Managers Index, was weaker than expected, though, with hindsight, the hurricanes and the Boeing strike might have had some impact there. But that number's been below 50 for a couple of years now. So there's something pretty depressed about that indicator. And it's been kind of correct. Industrial production has been sort of flat. So that suggests that we're not going to see a lot of surprises on industrial production. And then, of course, what's the bottom line on employment that came out on Friday? You had a good look at it.
Yeah, I mean, I think there was nothing in that report to really change our tune. The labor market still looks pretty strong. It was also a very low signal report. The response rate plummeted. You had both strikes and hurricanes. So, I mean, if you add back manufacturing payrolls that were lost because of Boeing temporarily and potentially the weather, payroll growth could have been totally different. So, we expect that to bounce back in November. But any major conclusions from that report that, like, the labor market looked materially different, I think was a bad move. You should have
Now,
just stuck to your
remind us
narrative.
again, we've got the two surveys, the household survey
Mhm.
and the payroll survey. Which one more accurately reflects how the weather's affecting employment? Is it household payroll or both or what?
Yeah. So in the household survey, they actually do measure if employees are not at work or if they're part-time and they're typically full-time because of the weather. That measure spiked. The combined total was about 1.5 million, which is similar to what happened when Hurricane Beryl struck
Mhm.
in July. But on the payroll side, you can't really tell um, whether those employees are at work or not or on payroll as of October 12th
Right.
is really difficult to know the BLS did say, hey, there were 44,000 workers basically from Boeing that were on strike and not counted in the payrolls. But we had a huge decline in temp employment, which ostensibly has to do with hurricanes, but you can't really tell. So the BLS just chalked it up to saying, hey, we don't really know the impact. But if July is any indication, the unemployment rate spiked a few percentage points in July, and then it came back down pretty quickly. Unemployment's still at 4.1%.
Right.
Things still look okay, all things considered.
I mean, basically, they had a hedge clause. I mean, it was
Yeah.
right up front. They said pay no attention to the payroll, any of the payroll
Hmm.
survey data, because we don't know how to adjust it for weather effects. The strike effects is not an issue, right? I mean,
Yeah.
the strikes do show up in the payrolls. So people that are on strike are not included as employed in the payroll numbers, correct?
Yeah.
Yeah, yeah. All right. So, but, on the other hand, we've had lots of other labor market indicators like initial claims and the job openings and the hires, and those all look perfectly fine. So,
Yeah.
all in all, our position is that the economy is still growing on that 3% trend line. Inflation has moderated significantly. The bond market, the bond vigilantes are not real happy with the Fed stimulating, especially since no matter who wins the election, fiscal stimulus will continue to be significant, maybe even excessive. And so the bond yield, we're still talking 4.5% as the range, but we're also putting on the table the possibility of 5% if, in fact, we continue to have strong numbers. Maybe we get some disappointments on the inflation numbers, but mostly, I think once the elections are over, no matter who wins, I think the reality is going to be that Washington is big and getting bigger all the time, and that's not necessarily something the bond vigilantes want to see happen. Eric, why don't we turn to our charts and maybe you can do a quick run through. I think we'd like to leave some time for a little discussion. So let's go there. Okay, so today is November 4th, and this is my handy dandy touch screen. Go ahead, Eric. I'm going to kind of sit back and roll the charts while you talk and interrupt you every now and then.
So yeah, this is a chart of the 10-year. Obviously, it's down about 6, 7 basis points this morning, but you can see that it got really depressed right before the Fed was cutting. We had some of those weaker payroll revisions, a little soft patch in the economic data. But this really follows what's been happening to the economic surprise index. We've had strong econ data, and so the 10-year yield has risen. I don't. I think there's a lot of questions on when does this become bad for stocks, and I think it matters why the 10-year yield is rising rather than like what level it's at. I'm kind of brushing off like the odds of a 6% 10-year. But if it's rising because econ data is strong, that's all good. But if it's rising like it did last August and September because we're worried about supply of treasury bonds and we hit 5%, that's a different story. So this is the bond vigilantes at work, kind of saying, hey, that was a little too much and too soon from the Fed. Both of these are measures of inflation expectations. The blue line would be break evens, and then the red line would be swaps. And you can see break evens blew out already to cycle highs, and that's despite oil prices actually falling. So I think that really points to the fact that the economy is doing well. Now the Fed is cutting and stimulating it even further, and then we're adding on the potential for more fiscal excess from already pretty high levels in terms of the deficit as a percentage of GDP. So I think it's a bond vigilantes, and as you can see, in terms of swaps pricing, they could definitely do more. Right, inflation could become more of a worry in there.
Eric, the increase in the bond yield has been led by this
Hmm.
expected inflation premium. I mean, the TIPS yield is up, but not much.
Not as much.
Um, wouldn't it be healthier for the economy and the stock market and the outlook if the bond yield was going up because of the TIPS yield? Because our sense is the TIPS seems to react more to the perception of the economy's strength.
Yeah.
So there's some indication of the economy's strength, but this is disconcerting to see that. And so here these Fed folks are going to be sitting around in their meeting on Wednesday and Thursday and saying everything is hunky dory on the inflation side. And the bond vigilantes have said, not so fast, or you've already moved too fast, and we're concerned about that. So that's something to watch out for.
Yeah.
But of course, today the inflation premium came down somewhat, or maybe the tips. We'll see.
I will
Go
say
ahead.
the Fed does
Go,
like that 5-year swap. That's like their favorite indicator for how they're doing, really.
right. Is that something that when you were on the desk at the Fed that
And I
was
pulled.
discussed? Hmm.
What was that, Ed?
Go ahead. Go ahead.
I actually can't. Okay.
Yeah.
Well, yeah. So I think the dilemma here for the Fed is, do they cut rates again and risk, yields going higher because the bond vigilantes think it's too much? Because in a sense, they're tightening financial conditions, which is like the opposite of what they want to do. If they're raising long-term inflation expectations, let's not bark. If they're raising long-term inflation expectations and then yields rise, so mortgage rates are a big thing for the Doves, especially. The housing market is, a lot of people are frozen out of it, but the 30-year mortgage rates back up, climbing towards 7% because the long end of the yield curve is rising. So it's a catch 22 for the Fed. Do you cut to ease financial conditions and then risk that actually most people's financial conditions get tougher? Um, it's not the easiest, but I think that they probably just shouldn't cut.
And this is the point you were making on the yield curve spread. It's now a positive, but it's still quite flat.
Yeah, I saw a number of people, and I think the New York Times quoted some people saying, the 10-year rose a bunch because people were buying it as a recession hedge. I think the yield curve would have been much steeper ex post. Like, had that actually been the case, I think the yield curve would have steepened a lot, but yield curve's still pretty flat. This is not like a normal steep curve.
Yeah, I mean this is typically what you see coming. Once it disinverts, it tends to disinvert pretty rapidly. At least
Yeah.
back here it did, and that's because there were financial crises back then. So once the crises hit, the Fed lowered short-term rates, and they fell faster than long-term rates. But long-term rates didn't just kind of go winging it to the upside. I mean, again, the Fed cut by 50 basis points, and the bond vigilantes tightened by 70 basis points or 60 basis points, maybe today.
Mhm.
It's something that is a major issue for the Fed because they lose their credibility if, in fact, the bond vigilantes are turning out to vote against what their policy is. And as you said before, it's not just the 10-year that's gone up um, on deficit concerns. I mean, you would think the 2-year isn't as sensitive to supply and demand as the bond yield
Mhm.
as the bond might be, but they've both gone up considerably. You did point out that the high yield spread just hasn't been uh, it's come down dramatically. There's
Mhm.
kind of been really no kind of recession signal. Even I guess back here, that was probably around March 2023. We had a small
Yeah.
hiccup there because of the banking crisis. Um, this is what you also mentioned before. Go ahead, give us a little take on this one.
Yeah, just you'd normally expect break-even inflation and oil prices to move in tandem. It makes sense. Oil is a key component of inflation. But they've separated or decoupled since the Fed cut, and I think that really points to the fact that it's U.S. inflation concerns due to both monetary and fiscal policy that are now driving long end yields higher.
Right. In other words, the bond vigilantes are actually acting like they're focusing on the long term now because the
Yeah.
short term's looking pretty good. I mean, we had good inflation numbers. The consumption deflator down to 2.1%. The GDP deflator is down to 2.1%. And so it was a little unsettling to see the bond yield. I mean, it's been going in the direction we thought, but still unsettling to see the bond
Yeah.
yield going up when the price of oil is going down and yeah, and so on. So, uh, you want to say anything about the bond volatility, the MOVE
Yeah.
index?
So this is the move index. It's like the VIX for treasury yields. Basically, it's been going up pretty rapidly. the election is in focus. There's the FOMC meeting, etc. But big swings in the long end of the yield curve aren't great for in terms of pricing and just in financing costs, but they've been pretty elevated. This is consistent with like Fed tightening the levels we're at right now, and we have the Fed easing. So I wouldn't say yet that the Fed has lost control of the long end, but that's what this is kind of pointing to. And the move has moved much higher than both the VIX and currency volatility. So it's a very bond market focused.
And
Um,
then let me move on, all right?
yeah,
Because we are getting some quick questions here. So join in, everybody. If you got some questions, we'll try to do what we can. But you mentioned the weather impact is basically a household measure. You can measure that with the household employment, not with the payroll. And
yep.
here you had this big spike in workers not at work due to bad weather. So that was that. We had the similar event back here with Beryl. And then we also have workers part-time due to bad weather, and that's also a household survey number, and so that kind of spiked up. So again, we think the weather and the strikes had a lot to do with this latest week series of numbers. Unemployment rate, again, it tends to once it goes up a little bit, it tends to go up a lot. That's the so-called SOM rule. And instead, it's kind of come back down again. All these things as in the past were associated with credit crunches and recessions. And this time around, we had a credit crisis in the banking sector, but no credit crunch and no recession. Um, I'm going to skip that one. You want to say anything about this one?
Yeah, just one of the key indicators we're looking for, labor market weakness is flows from employed workers to unemployed workers as a percentage of the labor force. That's still below 1%. So there's no, mass wave of layoffs happening. Nothing too concerning.
That's this one right here, right?
Yeah, the green.
Yeah. Okay. I'll skip that one. Our earned income proxy, which is a proxy for wages and salaries and personal income, managed to increase by 0.4%, even though aggregate hours worked was flat. We had a slight increase in payroll employment. And we had I mean, basically, payroll employment was flat, and the work week was flat. And
Yeah.
so we had a 0.4% increase in average hourly earnings. That's how much the earned income proxy increased. And we figure, I mean, seems to me like we could have a negative CPI or even deflator for September when the data comes out, um, because of the I guess I should say October, because when that's when energy prices fell a lot. So that could be a pretty solid increase in real wages and therefore real incomes. I think we kind of covered everything we wanted to. This is a chart that Eric did showing what is this again, Eric? This is the blue is all of kind of the average of October's.
Yeah, so this is the collection rate or response rate for the payroll survey. And so the red line is just, your annual averages, and then the blue line is October for each year. You can see October plummeted. It was like the worst October since 1985, below 50%. So again, tough survey to get much signal from.
Yeah, so it's not only did the weather mess it up, but so did well, the weather probably messed up the response rate as well. All right, why don't we open it up to a discussion, Eric? You want to field the questions?
Yeah, this first one is from Cagdis. Ed, two quick questions. One, do you think a unified Congress outcome is bearish for stocks, and that a split Congress or closer contested outcome is also likely bearish? And then, wouldn't the outlook for the stock market be asymmetrically bearish in the near term? And then the second question is, like, at what level or speed of the move in the 10-year yield, when does that start to bite stocks?
Well, I think starting at the last one, I think we probably agree, Eric, that if we broke through, I think if we break through 4.4, if you look at our little amateur attempt to provide some trend lines in technical analysis, I think if it goes up above 4.4% on the 10-year, it probably goes up to 4.7 pretty quickly.
Yeah.
And then the next stop would be 5. I think somewhere between 4.5 and 5, stock market would start to worry that the Fed has lost control and that the so-called Fed put is being nullified by the bond vigilantes would be kind of the way I look at it. Um, Eric, what's the latest? The latest I think is the Senate looks like it might go Republican, the House might stay Republican. So the way you get a sweep is if Trump wins. And yeah, I think the markets, the stock market, I think would have some hesitation about either candidate having a sweep. Market seems to do better with gridlock. Um, but if we have gridlock, I think that would be the more positive uh, outcome for the market. Eric, any thoughts on that?
No.
That's no kind of.
Yeah, we'll see.
Yeah, I mean it's a tough call, Cagdis, quite honestly. So I think we'll we'll do our best to come to some conclusions once we see what the result is. But if it's contested, that could be weeks away, and then what? Go ahead, Eric.
So this one, next one is from Aditya. Hope I'm pronouncing your name correctly. What are your thoughts on government spending sustaining the recent economic growth, and how would you expect Trump and Musk's government efficiency plans to affect that?
Yeah, well, all this stuff becomes politicalized pretty quickly here. So if we say that the reason we haven't had a recession is because Biden stepped on the accelerator where it came to government spending and deficits, we'd have half the country hating us, the other half loving us. But we try to be objective about these things, and the reality is fiscal policy has been stimulative, and it remains stimulative. There's still lots of money that's being spent on infrastructure, on onshoring, and with all the promises that Harris and Trump made, it certainly looks as though there's going to be a fair amount of tax cuts for some constituencies. And I think the bet would probably be there'd be more spending under a Democratic administration than there might be under a Republican. But again, it's hard to gauge. But I think the best bet is fiscal policy remains stimulative, which
Yeah.
is what the bond market's concern is about monetary policy joining the party here and becoming stimulative too. So I think that's been important.
All right, next one from Jim. I'm interested in how to define a melt up, and elevated PE ratio is clearly one indicator, but what defines that a melt up is occurring or has occurred? Thanks.
I think a melt up is when Warren Buffett raises a lot of cash into the melt up. I think Warren is a big fan of his so-called Buffett ratio. He didn't name it like that, but a long time ago, I think in the 85, 86 period, or no, maybe it was actually during the tech wreck period, the tech bubble tech wreck. I don't know exactly when, but he did come up with this notion that if you take the market capitalization, the value of stocks, and divide it by GDP, you don't want to see that ratio go above 2. And it got, I think, to 2.2 during the tech bubble. Now it's about 2.8. And so maybe he's looking at that. Other versions of the of this Buffett measure that we've talked about before are things like S&P 500 revenues as the GDP measure. So you take market cap of the S&P 500 and divide it by the S&P 500 revenues, and you get something very similar to the Buffett quarterly number. So we can track it actually weekly now because we use forward earnings and forward revenues to do that. So I think the valuation is I mean, if we have a melt up, it would be a PE-led melt up. I mean, and nobody's got a problem with the stock market melting up on better than expected earnings. So an earnings-led melt up is not really a melt up. It's not going to set the stage for a meltdown. I think melt ups are always easy to see after the fact, once they've been followed by a meltdown. I suspect people who invested in super micro were recognized they were in a melt up, but they didn't realize that the extent to which the thing could melt down when things didn't work out quite right. So the some of it is retroactively we could tell. But yeah, I think we're at valuation multiples that if we go any higher, I think we're officially in a melt-up situation. So I think I can justify 22 forward PE. A good part of that is the Magnificent Seven. They have a PE of about 30. The rest of the market has about 18, 19. So I think I can explain that, account for that, and live with that. Much higher than that, going to 25, I'd start to get very concerned about the melt-up scenario. Um, and that's we brought that melt-up scenario back down from 30% to 20% because of late we've become a little bit more concerned about the potential for at least some sort of debt crisis problem. So we're still using 20% as the melt up, and the reason for that now is if the Fed's going to provide candy and lower rates, but the bond market takes the candy away, that's going to be kind of confusing to the stock market, which is why we're staying with 5,800 rather than chasing up to 6,000 and above. I think some of our competitors did that when we crossed 5,800. We'll take one more, Eric.
Sure. We already kind of got at this, but Leslie mentions Warren Buffett raising cash. Jamie Dimon saying it doesn't burn a hole in his pocket to hold cash right now. I guess how are we thinking about cash is a good broad question.
Well, we've been thinking that the big difference between now and in the past is there hasn't been a, a credit crisis big enough to cause a credit crunch and a recession. And therefore, the Fed doesn't have to do what it's done in previous crisis environments, recession environments, and that is lower interest rates significantly, which is what at some point turns the stock market around when there's a perception that it's working. But here, the Fed doesn't have a credit crunch, doesn't have a recession, doesn't have a financial crisis that it has to deal with. Here, the stock market is at a record high, and the Fed's easing, and the bond market's going the other way. So there's always a lot of moving parts, and they're not moving in the way that people are used to. I think because we didn't see a recession, didn't call for a recession, because we kind of understood that the process of a recession is that the Fed tightens, you get a credit crisis, you get a credit crunch, you get a recession. We figured all that out early, and I think that helped you all. I hope thinking about what was wrong with that kind of doom and gloom scenario, and now we're sort of on the other end of that scenario where, hey, we're not in a recession, so the Fed doesn't have to do what it's done in the past. The inverted yield curve turned out to be useless as a recession indicator. Now it's turning out to be useless as a disinflating signal. So well, we're keeping nimble. Hopefully that helps your thinking on things, and we all have to keep nimble. And so don't forget to vote if you haven't voted already. And let's hope everything works out for all of us. It has in the past. I don't know why it won't in the future. So we're still roaring 2020s, and wish you all the best for the week ahead. Thanks, Eric.
Thanks, everyone.